Financial security requires knowledge of fundamental aspects of money management. When finances are actively managed, personal net worth usually increases over time, allowing for a more secure financial position. Valid financial information is difficult to come by because the people who most often want to talk to you about finances are people who want to sell you a product like whole life insurance or an annuity. Their livelihoods depend on their ability to sell their product. You could, of course, just go to the internet and look for financial advice. However, get-rich-quick schemes are a dime a dozen, and they never work. Utilizing high-quality financial accounts, products, services, and having a long-term plan is a great way to accomplish financial security. The best way, though, is to invest in a great education. For most people, the single biggest financial investment in their lifetime will be their home. It will increase in value over time. Debt on the home will be paid down, and that home will provide a certain level of financial security. For most people, the process works, and net worth accumulates the longer a house is owned. Even if you are nowhere near the point in life of buying a home, the process can be looked at as a how-to model for building wealth. Over time, as a home loan is paid down, the home becomes a progressively more valuable asset. Net worth grows. The owner will protect that asset with homeowner's insurance. When the time is right, the home can be sold for a profit or borrowed against. To manage the investment that is a home, a specific type of financial account is usually necessary, a mortgage. A specific type of financial product is almost always utilized, insurance. And whether it be an electrician, plumber, or heat pump technician, from time to time there are going to be professional services needed. Professional accounts, professional products, professional services. Cornerstones of financial security, regardless of whether they are used to buy a home, grow a retirement account, or save money for a college education. Our learning objectives are to identify common types of financial accounts, to differentiate between secured and unsecured loans, to identify investment products, and to identify professional financial services. Common types of payment accounts include checking, money market, and electronic payment services, aka piggy banks. 1 in 10 households in the US doesn't have a checking account and just uses cash for daily transactions. If you don't have a fundamental payment account, I want to encourage you, go get one. With FDIC insured banks, there's not a catch. There may be fees for overdrafting your account, but fundamental payment accounts are mutually beneficial. In exchange for being allowed to keep a customer's money for a while, a financial institution such as a bank offers convenience services like check writing, ATMs, debit cards. The way the bank does this for free is a portion of all the customer's money is invested into relatively safe investment vehicles on which the bank makes money. The bank makes money with its customer's money. In exchange, the customer has ready access to his or her money, both in person and online. It's a win-win. To navigate the financial landscape, use of financial products will almost assuredly be necessary. 2 dramatically different categories of loans exist: secured and unsecured. A secured loan is one in which the lending institution has collateral or ownership of a possession, such as a car or home. While the possession is being financed, it is technically owned by the financing institution. Upon the loan being paid off, then and only then does the possession become the property of the person who took out the loan. Unsecured loans are ones in which the lending agency is loaning money in good faith, in hopes that it gets paid back. Examples include credit cards, retail cards, gas cards, and even banks sometimes of course, based upon the customer's credit worthiness. Loan rates on unsecured loans are significantly higher than those for secured loans, which means you will pay significantly more when utilizing an unsecured loan. Introductory offers will make it seem as if credit card rates are low. However, there is an assortment of reasons why rates go up dramatically. Credit card debt can be crushing and dramatically impede a person's ability to achieve financial security. Be cautious with debt. Conversely, there are products designed to help you grow your wealth, such as CDs, traditional IRAs, Roth IRAs, pensions, 401ks, 403bs, and annuities. CD stands for Certificate of Deposit. It is a savings certificate with a specified fixed interest rate and maturity date. CDs usually pay a higher interest rate than savings, but there is often a penalty for withdrawing early. IRA stands for Individual Retirement Account. A traditional IRA provides a tax-advantaged way to save for retirement. Contributions can be fully or partially deducted so that income tax can be deferred to the future. Roth IRAs must be funded with after-tax money, but all the interest, dividends, and appreciation can be withdrawn after the age of 59 and 1/2 without having to pay any income tax on those gains. A pension is a type of regular payment made to a retiree from an investment fund to which the employer has and will continue to pay into. A 401k is a defined contribution plan where an employee can make contributions before or after tax, depending on the options offered in the plan. Based upon the employee's pre-selected choices, the money is placed in investment vehicles, such as mutual or bond funds. 3B is a TSA, or tax-sheltered annuity, and is similar to a 401k, but is specifically for certain employees, such as those who work for nonprofit organizations. They pay out a defined amount per month to a retiree based upon the value of the account upon retirement. Some products are just designed to make your life a little easier, while also providing a tax advantage. For example, a HSA, or Health Savings Account, is a tax-advantaged savings account available to those enrolled in a high-deductible health insurance plan. The funds contributed to an account are not subject to federal income tax at the time of deposit. A medical flexible spending account, also known as a flexible spending arrangement, can also be used to pay for out-of-pocket healthcare costs. Taxes are not paid on the deposits into the account. These types of accounts are often offered by large companies or state agencies to help their employees manage healthcare costs. The last component to building financial security is quite possibly the most important: identifying professional financial services. Finding high-quality information is difficult because the vast majority of people who will want to talk to you about finances are people who are trying to sell you an investment product. All investment products are not created equally. Agents selling whole life policies often receive upwards of 50% of the first year's premium as payment for selling the policy. Only a small portion of the premium is going to fund the cash value of the policy. I wish to emphasize, insurance is a necessary part of every financial plan, but insurance is for protection. It's not an investment. Annuities that are sold through your place of work often have significantly lower commission fees. This is especially true if you work for a large organization. The power of collective bargaining keeps commission rates in check. Financial professionals are people who have received rigorous academic training and are credentialed in their field. Math isn't easy. Neither is obtaining a finance degree from an accredited college or university. People who have a bachelor's degree can sit for the Certified Financial Planner exam, and if they pass, they can become a board-certified financial planner. Accountants can also provide financial guidance. They too are board certified and have a fiduciary responsibility to their clients. Some accountants have additional training to be a personal financial specialist, establishing that they met the financial planning requirements put forth by the American Institute of Certified Public Accountants. A good rule of thumb is that a worthy financial advisor will focus on creating a long-term plan to financial prosperity, instead of trying to immediately sell you a product to accomplish financial security. Be diligent in choosing appropriate financial accounts, products, and services. But most importantly, invest in your education.